Something snapped in the narrative. One week, Meta is the safe, mega-cap engine that prints cash from social advertising and whispers about AI at every investor event. The next, it gives the market a reason to doubt and the chart caves in. That is when opportunity and danger sit side by side. Right now, the share price is swinging around the low 600s, volume is heavy, and the story is loud. If you want clean signal, you are in the right place. Press subscribe with one quick tap so I can keep bringing you numbers that speak louder than noise. Let us start with the move that shocked people outside finance too. Meta just pledged an eye-watering $600 billion United States investment through 2028. Focused on AI data centers, infrastructure, and jobs. That is not a typo. It is a declaration that the company intends to own the plumbing of the next decade of compute rather than rent it. Reuters broke the figure and followed with context on how that spend ties to superscale data center builds and financing arrangements already in motion, including the Blue Owl joint venture and new sites underway. When a management team points that kind of money at a single theme, it changes how you model the next 5 years. It also raises obvious questions about payback and discipline. Now put that against what hit the tape days earlier. Internal documents reviewed by Reuters indicate Meta projected that about 10% of its 2024 revenue, roughly $16 billion, would come from ads for scams or banned goods. The company disputes parts of how that is framed, yet the report is out there and the market read it as a reputational and regulatory hazard that could impact budgets from large advertisers if trust is shaken. You do not need to speculate to understand why the stock slumped after that headline. If enforcement tightens, some near-term revenue walks away. If it does not tighten, regulators may. Either path carries cost. Either path can weigh on the multiple until clarity arrives. The earnings print added another jolt. Meta delivered record revenue for the September quarter, then reported earnings that cratered on the page because of a near $16 billion one-time tax charge tied to policy changes, while also telling investors that capital spending would rise again to a $70 to $72 billion range for 2025 as AI build-out intensifies. The combination is a perfect cocktail for volatility. Revenue shows strength, the tax hit masks profitability. The CapEx path reminds everyone that the bill for AI arrives before the payoff is fully visible. The after-hours fade and the post-print slide were the market's way of saying, prove it. Here is why that matters for your decision today. When a mega cap sells off on mixed signals rather than a collapse in demand, you often get a window where perceptions move faster than fundamentals. Headlines argue about spending. Algos punish the print. Long-only money asks whether the goalposts just moved. If the core engine is intact, that window can be a gift. If the engine is stalling, that window is a trap. Your job is to separate cash generation from optics, then judge whether the investment plan has a realistic path to returns. On the cash side, Meta's quarter still showed a powerful ad engine. On the optics side, the company voluntarily tied itself to a very large capex runway that will be measured line by line on every call from now on. Watch how the market is framing Meta inside the small club that dominates indexes. In the first days after the print, coverage across investor media started calling Meta the new laggard of the Magnificent Seven. Not because the business suddenly broke, but because peers such as Nvidia and Microsoft have an easier story to tell on AI returns right now. That label can drag sentiment in the short run. It also creates a simple test. If Meta can move the conversation from spend to monetization with receipts, the label flips quickly since expectations were lowered during the slide. You need one more piece before we zoom into the next catalysts. Price targets are drifting higher on the long horizon even while the near term is noisy. Several houses have reiterated or raised targets that cluster around the 800s, with some outliers pinning 900 on full AI payoff scenarios. Those are not promises. They are models that assume robust ad growth, progress in AI products, and controlled unit costs as new data centers light up. If management executes, those numbers act like magnets on good news days. If execution slips, they turn into ceilings. Use them as context, not as a script. Here is what the next few weeks are really about. The market wants to hear how quickly compute spend turns into product wins that advertisers can feel. In English, that means prove that AI tools are lifting return on ad spend. Prove that AI video and creative tools are saving marketers time while improving conversion. And prove that the company is not just building servers, but building experiences. Citi and others have already argued that Meta's AI tooling can be a lever in its favor, yet the stock will not take anyone's word for it anymore. The next appearance from management needs to translate the 600 billion vision into a near-term user and advertiser story that hits a dashboard, not just a press release. You also need to account for the calendar. The next fully confirmed earnings date for the December quarter is expected in early February, with several trackers marking the first week, and Meta's own investor relations site will post the official time once it locks. Between now and then, expect smaller data points to move the needle. Any update on CapEx cadence, any disclosure on the shape of the Louisiana Hyperion project financing, any change in guidance language around AI infrastructure could add or remove billions of market cap in a single session since the stock is trading on spending and payoff. Keep your eyes on Meta's own investor page, not reposted screenshots. Let us talk about the crash itself because price action has a memory. In the days around the print, articles tallied a double-digit slide and highlighted how the market reacted to the spending outlook by drawing comparisons to the 2022 Metaverse drawdown. That comparison is useful as a warning, not as a prophecy. The difference now is that AI sits directly inside Meta's core ad engine and creator tools, while the Metaverse bet asked investors to fund a separate frontier. If the company can demonstrate that new models lower cost per action for advertisers and drive more time spent in product surfaces that monetize well, the market will forgive heavy spending faster than it forgave Reality Labs' losses in the last cycle. If that proof does not show up, the comparison sticks and the multiple stays capped. There is a second narrative pressing on the stock that you cannot ignore. The Reuters investigation about scam and banned goods ads put a spotlight on quality and enforcement. If that turns into formal probes or advertiser boycotts, the cost is obvious. If Meta shows credible progress that reduces the proportion of revenue exposed to bad actors without denting growth, the overhang lifts. This is not a problem you solve with a slogan. It requires verification and clear yardsticks that brands can trust. Expect that to be a live topic on the next call and at any interim investor appearances. At this point, you might feel the tug of two stories pulling in opposite directions. On the one hand, a 600 billion commitment tells you this company is building a wall of compute around its future. On the other hand, the core ad engine must carry the weight while that wall is built, and it now faces deeper scrutiny about ad quality. This tension is exactly where asymmetric trades live. If you wait for perfect clarity, you do not get the discount. If you act before the next receipts, you accept that your thesis could take a punch if management stumbles. There is no way to avoid that trade-off. There is a way to define it so you do not guess. So here is the practical lens. Watch the next official comments for 3 ingredients that change price behavior quickly. First, look for numbers that prove AI tools are improving advertiser outcomes in a way that can be scaled without a proportional rise in unit costs. Second, look for spending cadence that shows discipline rather than drift, meaning dollars tied to projects with clear milestones, not slogans. Third, look for a credible plan to reduce scam exposure and the willingness to sacrifice the dirtiest revenue in order to protect the brand with regulators and blue-chip advertisers. When those 3 appear together, even for one quarter, you usually see a rapid re-rate because investors love growth that travels with governance. There is also a portfolio lesson here that often gets missed. When a mega cap sells off into a wall of worry, relative value investors look across the Magnificent Seven and ask which name gives them the most upside for the least headache. Right now, coverage pieces that call Meta the laggard create an opening. If management answers the quality and CapEx questions faster than peers answer their own issues, the label flips and money rotates back. The market's memory is short when cash flow speaks. None of this erases risk. If the company misses the mark on ad quality and regulators turn up the heat, you can get multiple compression even with revenue growth. If the capex line expands faster than expected and the product side lags, investors will push back hard. If the competitive field moves faster on AI experiences that users love, Meta will look like a follower, not a leader, and that matters for premium valuation. Make room for that in your thinking. Your edge is not in predicting the future. Your edge is in knowing exactly what the market needs to hear to change its mind, than watching like a hawk. Let me pull you back to what you care about. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. The stock is still a giant that throws off enormous revenue and cash from its core. The company has chosen to spend heavily to build a long runway for AI, and it has linked its credibility to execution on that plan. Reports about bad ad dollars have cut into trust at the worst possible time. Yet they also set up a chance to win back that trust by showing measurable progress and holding the line on standards. Analyst targets in the 800s and a handful around 900 tell you what the price looks like if the plan works. The slide after earnings tells you what happens if the plan feels vague. Your decision sits between those two poles. Here is how I would watch the next tape action without getting lost. If price can build a base above the first post-print lows while volume fades on red days and picks up on green, it signals that institutions are soaking up shares from shaken hands. If price keeps making lower lows on rising volume, it tells you that the market wants a bigger discount before it believes. Pair that with any interim comment from investor relations about capex pacing or site progress and you will know whether the story is stabilizing before the calendar rolls into February. One last point because it will save you headaches. When a figure as large as 600 billion hits headlines, everyone repeats it. Then some people try to minimize it by calling it political theater. The only numbers that matter for your model are the quarterly and yearly capex lines that flow through the cash flow statement and the project milestones the company discloses. The pledge sets ambition. The statements pay for it. Keep your eye on the ladder, verify every dollar on Meta's investor site, and you will not be whipsawed by hot takes. You asked a simple question. Is this crash the perfect buying chance? Here is the honest answer. It can be, if the next communications show a business that can turn enormous spend into better products for users and better outcomes for advertisers while cleaning up the dirtiest revenue. The path exists, the cash engine is strong, the ambition is clear, the burden of proof is now on execution. If that proof shows up, you will not need a narrator to tell you. You will see it in the numbers and you will see it on the chart. This is it for this video guys, thanks for watching and please make sure to subscribe, like and leave a comment down below.